Hi there, my name is Peter Bartregin, and I want to explain to you the difference between mortgage insurance that you actually get from a bank or mortgage insurance that you would actually receive from, say, an advisor like myself. So at the bank, when you have what they call debt insurance, there are a few things that you need to understand in regards to what you're actually getting for a product. First thing is that the face value of the actual policy is based on the value of your mortgage. So if the mortgage is paid down throughout the years, well, so is the face value, but your premiums stay the same until you actually look at a renewal or you decide to change the institution of where you got your mortgage. And then again, you'll have to look at paying potentially higher premiums because insurance is based on your age. So as we get older, the cost of that insurance goes up. Second, the beneficiary is the financial institution. Third, so as I mentioned earlier, if you decide to change institutions with your mortgage, then you'll have to basically look at getting another policy, and again, it's going to be at a higher premium. More importantly, when you look at that type of insurance, sometimes there will be some underwriting, and what I mean by underwriting is basically approval of actually having the insurance in place, that if something happens to you and you become an angel and all and things happen of that nature, then there's a question of whether you're actually going to receive the payout, because typically the financial institution receiving the payout, the insurance company or the debt insurance does not go through medical underwriting until a claim is actually submitted. So sometimes what happens, the insured, at that point when the underwriting is completed and the claim is put in, that the policy wouldn't have been paid out in the first place because they weren't insurable. So there's a lot of reasons why you want to consider looking at a separate insurance policy, for you and your spouse, or if it's just you yourself. The face value stays the same. The premiums can stay the same for the duration of the actual mortgage itself. So you can look at a 10-year, 20-year, or even a 30-year term policy. Third, you decide who the beneficiary is going to be. When you decide who the beneficiary is going to be, it's going to be, for example, say your spouse. Then your spouse is going to receive the full face value of the policy. And if you submitted for a $250,000 policy, your spouse is going to receive a $250,000 check. Okay, all those proceeds are tax-free, and what happens from there? The spouse can decide whether he or she will pay off the mortgage or not, or maybe they have other plans for the actual proceeds. The value stays the same, and it doesn't go down as you pay down your mortgage. So you're really getting the full benefit of the actual policy. The underwriting is done up front, so it's done up front and approved, and that way exactly and be secure in the fact that if something actually happens to you, then the policy will be paid out. And so and actually one more thing, if you decide to change institutions because you get a better rate or maybe a better service, or there are lots of different reasons, buy or sell a home, then you don't have to worry about getting insurance because that insurance is in place. And I'll add one more fact to that, to the reason why of having the separate insurance in place. You can convert your policy to a more permanent solution. So you can take all or some of it and convert that into a policy that you know is going to be there for the rest of your days. And that's something that's contractual. It's not something that you'll have to go through underwriting and get approval again and all that kind of good stuff. So I hope I provided some information for you. And if you have any questions, please feel free to message us, and we'll talk to you soon.